Hey folks, welcome to a product review at Finominal. Today we're going to analyze the largest buffer ETF, which is a product from First Trust and Cboe West that trades under the ticker BUFR, BUFR. Now, what does this product offer? It effectively offers limited downside, but also capped upside. And there are buffer ETFs that expire on certain dates, on a quarterly basis one, but there's also this product that effectively is a fund of fund and allocates to other buffer ETFs from First Trust, and so kind of rolls these forward that investors continuously get the same profile. Now, let's see actually what this product does and how it ticks and if it's of value to investors. And the first thing we're simply going to do is compare this to the S&P 500 using the securities analyzer. And we do that simply because BUFR is comprised, and now I'm talking about the underlying ETFs, of large cap stocks with options that provide that profile between limited downside and capped upside. Now, what we see from a pure performance perspective is that since its launch in 2020, effectively that BUFR ETF has had the same trends as the S&P 500, but was less volatile as expected. And we can actually look at that. So the volatility over the last 3.7 years was 10.7% versus 17% for the S&P 500. Now, the return was lower as expected. Kind of interesting is that the Sharpe ratio actually of the buffer ETF was slightly higher than for the S&P 500. So that's kind of nice to see. Now, moving on to the key attractive feature of this product is the drawdowns. We can see that during the kind of like minor bear market in 2022, where the S&P 500 fell by 24%, the buffer ETF only fell by 14%. So kind of achieved its objective of providing limited downside. Now, let's have a quick look in terms of what this product has in terms of asset class exposure. Now, we know it only provides exposure to equities. And so we would expect to see beta. And what we're going to do is use a returns-based effective exposure analysis, where we see the betas to the core asset classes over time. And what we see effectively that there's no exposure to bonds, currencies, or commodities as expected, but we do see a relatively constant beta to the S&P 500 between 0.5 and 0.6. Now, that kind of raises the question if this product simply represents diluted equity exposure. And we can evaluate that with another tool called the Time Machine. And what this does is a very simple replication just using equities and cash. Now, we're going to look at this scenario over here, which effectively tries to replicate the buffer ETF using only the S&P 500 and cash. And indeed, we do see that a 62% allocation to the S&P 500 and a 38% allocation to cash would have resulted in something that is almost the same with the same volatility, which in this case was 8.88%. Now, that's not so great for thinking about this product because effectively it simply means it only represents diluted equity exposure. And investors can simply achieve the same profile by allocating from equities to cash. So that makes this slightly less attractive. Now, in case you're still interested in these kind of strategies and you're wondering, is there a cheaper alternative to BUFR? I think there is. So BUFR charges a management fee of 20 bips. And we can see there's another product from Innovator, which is also a fund of fund, providing exposures to buffer ETFs, trades on the ticker BUFB, that only charges 10 basis points as a management fee. And you can see the performance is almost the same. Now, having said that, these are only the management fees. And what you actually have to do with regards to this product is look through at the total fees because it's a fund of fund and therefore there's a double layer of fees. So effectively, the total fees of BUFR are 1.05%. So this makes this quite an expensive product. And given that the product itself is kind of like an equities cash application, that is not favorable for it. And that kind of like sums it up in terms of how we think about the product, that there's a limited utility for this from our perspective. You could argue that as an investor, if I have a expectation that a market will trade range bounded over the next 12 months, and I want to limit my downside, but I don't care so much about the upside, you can use it for that purpose. Having said that, that's pure market timing. And unfortunately, no one is particularly good at market timing. So that defeats the whole purpose of this product. And then considering that this is just diluted equity exposure, where you have to pay 1.05% per annum on a look-through basis, that does not make that very favorable. And there's just other strategies. So if you're looking to reduce equity risk, diversify via bonds, alternative strategies, or simply go into cash. And that seems to be more sensible. That summarizes this, and hope that was helpful. Have a nice day.